Hello and welcome. In this video, we will continue looking at choices of call options that a trader could sell to place a covered call on Yahoo. At the time of making this video, Yahoo is $33.76 a share. In the last video, we looked at two out-of-the-money strike prices that a trader could sell to place a covered call on Yahoo. Instead of selling a call option that is out of the money, a more risk-adverse trader could choose to trade some of his upside potential for some downside protection by selling an option that is in the money. Instead of buying 100 shares of Yahoo for $33.76 and then choosing to sell a $34 or $35 strike price, a trader could choose instead to sell the $33 strike price. The $33 strike price costs $2.05. Selling the $33 strike means that the trader collects $2.05 up front. If the price of Yahoo is still above $33 when the option expires, the option is exercised, which means that the trader sells his 100 shares of Yahoo for $33 a share. He paid $33.76 for Yahoo and sells it for $33, so he loses 76 cents a share on Yahoo. But he was also paid $2.05 up front selling the call option, so his profit is $1.29 a share. The trade is closed, meaning that all risk is taken off of the table. If the price of Yahoo drops and stays below $33, the option the trader sold expires worthless. The trader keeps his 100 shares of Yahoo, and the trader keeps the $2.05 that he was paid up front as profit. The next month he can sell another call option and repeat the process. The trade is still ongoing, so risk of loss is still present. The trader paid $33.76 for Yahoo, and he collected $2.05 up front, so his current break-even point is $31.71. If the trader wants even more downside protection, the trader could place a covered call by buying 100 shares of Yahoo for $33.76 and selling the $32 strike price. The $32 strike costs $2.66. Selling the $32 strike means that the trader collects $2.66 up front. If the price of Yahoo is still above $32 when the option expires, the option is exercised, which means that the trader sells his 100 shares of Yahoo for $32 a share. He paid $33.76 for Yahoo and sells it for $32, so he loses $1.76 a share on Yahoo. But he was paid $2.66 up front selling the call option, so his profit is 90 cents a share. The trade is closed, meaning that all risk is taken off of the table. If the price of Yahoo drops and stays below $32, the option the trader sold expires worthless. The trader keeps his 100 shares of Yahoo, and the trader keeps the $2.66 that he was paid up front as profit. The next month he can sell another call option and repeat the process. The trade is still ongoing, so risk of loss is still present. The trader paid $33.76 for Yahoo, and he collected $2.66 up front, so his current break-even point is $31.10. Let's compare selling these two strike prices to selling the two out-of-the-money strike prices that were discussed in the last video. To recap, at the time of making this video, the price of Yahoo is $33.76. If the price of Yahoo is above the strike price when the option expires, the option is exercised, which means that the trader sells his 100 shares of Yahoo to the buyer of the option at the strike price of the option. This is known as being called out. Getting called out closes the trade, locks in profit, and removes all risk. If the trader sells the $34 or $35 strike, the price of Yahoo has to rise for the option to be exercised. Whereas if the trader sells the $32 or $33 strike, the option will be exercised unless the price of Yahoo drops. Selling an out-of-the-money option will generate more profit if the option is called out. Part of the profit will come from the rise in the price of Yahoo, and part of the profit will come from the premium the trader collects from selling the call option. Selling an in-the-money option will generate less profit if the option is called out. The trader collects a higher premium up front, but the trader loses some money on the underlying stock. However, in-the-money options have a better chance of getting called out. In other words, selling an in-the-money call means that the trade has a higher probability of the trade being profitable, but the profit will be lower. If the price of Yahoo drops instead of rising, selling an in-the-money option also gives more downside protection than selling an out-of-the-money option. The trader collects a higher premium up front, which lowers his break-even point. The more in the money the option is, the higher the premium that is collected up front, and therefore the more downside protection that the call option offers. So if the trader is looking for the highest possible profit and he is more risk tolerant, he may choose to sell a call option that is out of the money. However, if the trader is more risk adverse, he can increase his probability of the trade being profitable and increase his downside protection by selling a call option that is in the money. I hope that you enjoyed this video. The next videos in this series will look at common strategies a trader can utilize placing covered calls. Thanks for watching.